Do we actually get an OPEC plus deal, forget the U.S. for a second, on Monday?
Hey, Alex. I think the base case is that there will be a safe phasing deal. I think the entire OPEC plus group underestimated the impact on demand. But just let's be clear, the Saudis are looking for market share. They're looking for a capitulation across the cost curve. So whatever this deal is, it will fall short of enough to get oil prices to rally to a point where everyone can come back. They're still looking for a retrenchment of volumes in capex by U.S. shale and the majors. So whatever this deal is, it will still ensure that base case market share plan is intact.
So the Saudis have been very strict in terms of we will not cut unless others are with us. Does that others now extend to the U.S.?
I think we may see some sort of U.S. concession, but the way we're sort of thinking about this is that we've got two tracks you've got between the U.S. and Saudi. One track is strategic, bilateral. It's concessions. It could be potentially just being removed, FDIs from the U.S., maybe other sort of agreements in place between the Saudi and the U.S. And the second track is this essentially aiming for U.S. shale in terms of looking for restructuring of the industry and the majors, the IOCs along that. Now, the reason I mention that is because I think if you think about that first track being concessions, Saudis may not request or push for U.S. to cut. They may push for something else in regard to those concessions with Trump.
Well, and the same question really for Russia, too. I mean, the question like, what does Russia get? No doubt the talk has been around sanctions, right?
Absolutely. I mean, the reality is that with demand so weak in Russia, they've got oil that nobody wants. So there will be an effect of capitulation around this production volume hike in the context of, for example, Rosneft, where they're looking to increase production, but that demand hasn't responded. So we could see Russia potentially present up to 1 million barrels a day of reversal in production cuts. But then again, Russia would have to agree with Saudi, and Saudi would have to do the lion's share of the cuts. I just don't see how we even get anywhere close to the 10 million barrels, even if Saudi and Russia were to corroborate, unless, to your point, Alex, we do see everybody else across the world provide cuts, which we think is very unlikely.
So let's pretend for a second that the rest of the world does chime into something. When your models, what kind of cuts are we going to need to see to not have WTI go to 20, like to just stabilize, say, at 30?
We'd need at least 15 million barrels of production cuts to the end of the year, 15, to see oil prices stabilize between $30 and $40. If we see production cuts of close to sort of 6 to 7 million barrels, which would be a Saudi plus US plus Russia plus, that would see oil at around $30, because the backdrop is we've lost between 15 and 20 million barrels of demand this year. There's no way that can be recouped in terms of production cuts at this point, which you could argue is the miscalculation of OPEC in the context of not agreeing to a deal. They didn't see how bad demand would be, and now it's too little and too late, which is why we think that Saudi's base case strategy still remains market share, even if there is this sort of compromise deal in the interim.
One thing that it feels like, and after reading some analyst reports, that it could do is actually lower freight rates, because now you have Saudis fighting for market share, like you've said. So they're using a lot of VLCCs, very large cruisers, to transport crude. Prices are increasing for the usage of that, which makes the U.S. oil uneconomic. That's not going to ship to Asia necessarily if freight rates go too high. Does this kind of calm down the freight market, in which case we will have a valve in the U.S. to export? We're able to have more oil moving around?
Absolutely. I think, in fact, that's probably the positive corollary from this, is that you put a deal in place, even if it's a soft deal, so to speak, and that does mean that freight rates come down. It also means that you can find a home for some of this storage, and so there's a bit more release within the system. But I would argue that even through this process of trying to put a deal through, we have the risk that it falls apart, or we see lack of compliance. So this could be a one step forward, two steps back situation. Not to mention the fact that the clearing price for oil, as we see inventories reach max storage over the next 4 to 6 weeks, could see oil prices fall down to as low as $10 to $15 as a function of that clearing price. So I do think this is actually worse than the oil embargo of the 70s. There's no clear path. I think one's being being defined or trying to be defined by President Trump. But the reality is that the net could be a lot worse in 2 to 3 months based on the clearing price of oil and the deal collapsing.
You are sort of out of consensus for the longer-term oil price in that you think that the destruction that we're seeing now in the oil market is actually going to lead to higher prices later because we're going to have a real supply gap, meaning that the fields now are not getting the kind of maintenance capex they need, the OPEC. There's going to be no new field discoveries that are going to be able to really get going, so we're going to see a supply gap. What does this do to that thesis now?
Absolutely. I mean, we published something this morning we looked at, sort of looking at all the capex cuts in the Europeans. Roughly $15 billion of upstream capex is being cut. I mean, I'd argue cancelled, given it's unlikely to come back in the near future just for this year. And that's only 4 weeks since the OPEC deal. Now, that equates to roughly 600,000 barrels of production just for the European majors. If we interpolate the US guys, we're talking close to 1 million barrels of production that's been deferred from 2020 to 2021. I don't think that production comes back, again, because that capex is likely to be redirected elsewhere into energy transition. So what that does is if we have a supply peak of 2022 as a base case, Alex, with that production now being deferred, we're effectively pulling forward that peak into second half of next year. So I do think there's a reap what you sow moment for the oil price, and that these levels aren't sustainable. Investors are asking about the sustainability of these prices over the medium term. And what it does mean is that there's clear volumes being taken off the market, which you can then sort of marry with where current production is for the oil market. And you can that generates this sort of line of sight that we just don't have enough oil to sustain production beyond middle of next year onwards, which clearly creates a super cycle sort of thesis, which, interestingly, looking at the European equities and how they're trading, it looks more and more like a positive decoupling to oil in the near term and a more recoupling to the forward curve, because that's more relevant in the context of that supply-demand outlook.
Interesting. So following future prices rather than the spot price. Based on that, though,
right,
what kind of global recovery do we need to see after this virus to make that thesis pan out?
Yeah, it's a great point. I mean, I think the thesis is predicated on the recovery from 2021. We may not go back to 95 to 100 million barrels. It's likely more in the mid-90s in terms of demand. There will be some structural impairment to demand. We are still not sure as to what's going to be permanent damage versus cyclical. Having said that, given we've lost about 1 million barrels of production already through these capex cuts, given we see supply not being sustained beyond second half of next year, the reality is from 2022, when we do see demand recovering into the high 90s as a base case, that's where we could see demand effectively catch supply out by virtue of there not being enough. Now, the key assumption here is that Saudi continues to moves ultimately back towards a cut rather than a market share beyond next year. We do think they will ultimately come back to a more stricter framework around quotas. And if that's the case and OPEC behave, then it will be likely that they'll ensure that supply gets neutralized through whatever new demand level emerges in 2021. But I think that the thing that I think most of the long-only investors that we speak to are sort of considering, even in this bear route, is whatever demand recovers to, if the next 3 to 4 years horizon sees that there's just not enough volume out there to keep up with whatever that demand level is, and it's the second order, which is what oil will trade towards, which is that as and when demand recovers, there just won't be enough supply to meet that demand.
So based on that, I know you have a buy rating on a couple of the European majors, like a BP, for example. When is it good for a longer-term investor with a 3-year, say 5-year thesis to start investing, in which ones?
Yeah, we're actually recommending right now. I mean, even though we could see oil prices dip much lower through the clearing price and over inventories, we see that there is this correlation towards the mid to back end, and therefore stocks like Total, Galp, Equinor, which have got loads of super cycle leverage, so to speak, with a lot of oil volumes still coming online, even with the capex cuts. So plenty of oil under their bonnet, so to speak, but also have the resilience through low cash break-evens, balance sheets that can absorb the dividend, even if this is a sort of prolonged downturn of 12 to 18 months. So it really is who's got the barbell of resilience and super cycle leverage. And that's Total Equinor and Galp. The flip side of companies that are more exposed to dividends at risk is Shell, Repsol and OMV. We think those are the ones that if we do see a prolonged downturn, we'll find it a lot more difficult to defend the dividend.